Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about the most recent CPI report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. Inflation is useful to track because we do know that it can often affect market conditions. Historically, when you have periods of high inflation, it can lead to rather lackluster market returns for the better part of 10 to 15 years, depending on how long inflation persists. This is one of the reasons why Jerome Powell and the Federal Reserve are so determined to get inflation durably back down to their 2% target. Above that, the economy, as Jerome Powell often says, just does not work for anyone. And it's not to say that layoffs are a good thing. We know that layoffs are not, but it is to say that inflation and prices going up and up and up is going to continue to make it harder for everyone to just be able to afford basic necessities. So we're going to talk about inflation here year over year, and then we're going to go look at core inflation. We're going to break things down a little bit more. Now, first of all, we can see that inflation topped out back in June, at least headline inflation did, and ever since then it's been slowly coming back down in a somewhat of a stochastic process, which we said is the most likely outcome. Now, back over here in June, we suggested that we could see a bit of a bounce in inflation. We noted back then that some of the prior headwinds for inflation were going to become tailwinds. Some of the base effects were no longer going to be as favorable. And because of that, we said that in the short term, in the next few months, we could in fact see inflation go back up. However, as time goes on, the expectation, in my opinion, would be that it sort of slowly fades back to the downside. Now, if you go back and look at my CPI report video from a couple of months ago, there were certainly a lot of people that, especially in the comment section, that were thinking that oil would continue to sort of go up and provide a tailwind for inflation. But I said back then that we will likely see it sort of top out around this time frame, around September, and see it come back down, just because we're going to start to see all the lagged effects from all these interest rate hikes finally start to set in and hit the economy. And so I think that's essentially what's happening. The Fed has, that they are being successful in slowly slowing the economy down. The only question is are they going too far? Have they gone just far enough? There is this theoretical idea that there exists an interest rate, let's call it R star, at which above that level, the economy contracts, and below that level, the economy expands. And so the sort of the thing that we have to think about is, well, is 5.5% sufficiently restrictive? Now, I suggested more than a year ago that 5.5% would likely be the terminal rate, and I think that it is sufficiently restrictive. I don't think that the Fed needs to raise interest rates anymore. It doesn't mean that they won't, but I don't really think they need to. I think that what they need to do is just hold interest rates here for as long as they can, even if the labor market shows weakness, which it is starting to do. So inflation year over year right now is coming in around 3.2%. That's headline inflation, and at least it is starting to come back down. Now remember, one of the things that I often see people confuse is the difference between disinflation and deflation. Just because inflation is coming down, which is disinflation, does not mean that you should expect lower prices. Lower prices would occur if we get into something known as deflation. But we are not we are not currently in deflation, at least for headline inflation. We are in certain categories theoretically, but we are not looking at that right now. Now, we can break this down. We can look at the year over year percentage change per category, which I think is useful to do. Here you just have headline inflation, so you can see that it's been slowly coming back down. A stochastic process, which is what we said was the most likely outcome. If you look at food and beverages, it continues to come down. Last month it was at 3.73%. Now it's come down to 3.32%. The issue, though, is has the Fed gone too far? And if they have, then we risk inflation going below 2% and going much lower than that. Now, you might say that sounds like a good thing. And hey, I'm right there with you. I wouldn't mind prices going back down. Of course, the issue is that prices go back down and things start trending in the opposite direction, then that would likely negatively affect the stock market, right? If prices are generally trending down. But food and beverages has been coming back down, which is a positive sign. Housing, slowly coming back down, right, from 5.56 down to 5.25. Housing is one of the things that lags the most, so I would suspect that this thing is just going to keep coming down as the months go on, and should provide a headwind for CPI for a long time, and will likely make it so that headline CPI continues to drop. If you look at apparel, you can see that it's currently at 2.62%, up slightly from 2.26% last month, but still generally, trending in the right direction. If you were to look at like a 3-month moving average, of course, you can see that it is trending in the right direction that the Federal Reserve would more or less want to see. We can go look at transportation, which has actually been deflationary recently. If we go sort of zoom in over here, you can see that back in March, April, May, starting in March, not April, but then May, June, and July, it was actually deflationary. Right now, recently it has become inflationary again, but pretty low. This last month, it decreased from 2.37% down to 0.71%. So that is well within the range of sort of what we would have expected. Medical care, if we look at that, it has gone deflationary theoretically. Though I haven't really seen medical costs come down, but it is one of the things that is impacting headline CPI. We can, of course, take a look at recreation, which is still, in the grand scheme of things, relatively elevated, right? Let me sort of zoom out here, right? So it's, last month it came in at 3.88%. Now it's dropped to 3.18. We could look at a monthly change on this, maybe even apply a moving average to that and see that it is in a disinflationary impulse. But it is still well above, I believe, where the Fed would want to see it. Remember, the Fed wants to see things down at 2%. This is still at 3%, meaning that, rates need to stay higher for longer in order to achieve this objective. Now, there's an argument that they should start cutting rates before we get to 2%, sort of like to try to soften the blow and achieve a soft landing. But historically, the Fed, does not do something like that until something starts to really look really weak in the economy. You can look at education and communication and see that it came down from 1.07% to 0.928%, and then other goods and services, which actually went up from 6.01% to 6.19%. Now, if you were to look at a 3-month moving average of this, it still seems like it's slowly trending in the right direction, but it's taking a long time. You can see prior periods where it also had some pretty significant spikes, all of which, by the way, it corresponded to a recession in the not so distant future, or, we were sort of coming out of one, right? Every single time this thing spiked. And you can see right now it's continuing to stay relatively elevated. And again, arguably the Fed has to keep rates higher for longer in order for them to sort of see this one go back down to their 2% target. Now, if you look at core inflation, you can see that it hasn't really skipped a beat. It continues to come down. It's currently at around 4.02%. Note that this was an area that we did spend some time at back over here around that 4% level. And you can see if you look at a monthly change that the pace at which it's dropping is slowing down. So instead of dropping by 0.26% or 0.315% the last couple of months, now it's only dropped about 0.111%. So ideally, I think it would be good if in the coming months we could see this continue to trend down. If it gets sticky at 4%, then that's going to not really be a great thing, because it just means the Fed has to keep rates higher for even longer than perhaps the market is even expecting. The way this impacts the markets is because as inflation remains sticky, then the markets, if you think about inflation and how companies will sort of pass on the cost to the consumer, one of the things to think about is if inflation comes back down, then that's going to likely negatively affect the bottom line of a lot of companies, especially when comparing to, say, a year ago when inflation was a lot higher. So that is something that I think we have to consider when thinking about inflation. But again, our expectation for a long time has been that it would slowly come down, that it would not be a linear process, that it would be a stochastic process, and it seems like that has been the case. It's just taking a very long time, right? And, here you can see inflation was around 9%, in the summer of 22. Now it's down to about 3% in November of 2023. So it is moving in the right direction. This is a welcome change. If you look at the monthly change on this, you can see that it's accelerating to the downside. Last month, it only dropped about negative 0.0176%. This month, it dropped about negative 0.458%. So it does seem like it's starting to accelerate to the downside once again, but we will need to see it continue to print these numbers in the coming months. The reason, of course, how this affects markets is, we can go look at the bond market and look to see what they're predicting. Just let's reload the page to make sure we have the most recent data. at the next meeting. The bond market essentially thinks the Fed is done. I think the Fed is done. I don't really think they need to go above 5.5%. If you look at probabilities, there's basically almost 100% chance that they stay at 5.5% come the December meeting. When Powell was asked about the SEP, the Summary of Economic Projections from the prior Federal Reserve meeting, he sort of brushed off the idea of another interest rate hike, and I think for good reason. They don't need to hike again. The labor market is cooling off. The PMIs, right, these surveys, these manufacturing surveys and whatnot, they're cooling down. The economy is starting to show signs of weakness. They don't need to hike again in order to obtain their objective. I think they just need to be willing to hold rates higher in order to see inflation durably come back down to target. The issue that they want to avoid is lowering interest rates too soon, because if they do that, then they could just see another wave of inflation come back over the next 1 to 2 years. So the question is can the Fed stay the course until the job is done, which I think they will do. I think that they've been embarrassed by this whole inflation is transitory. I think they're going to do what they need to do. Now, over the last 2 years, their job has been relatively easy, right? I mean, inflation is high, so you have to raise interest rates, right? You have to reduce the size of your balance sheet. It's a pretty clear outline of what the Fed needed to do. But they have two mandates, not only price stability, but also maximum employment. And now we're getting to the point where the labor market is starting to soften up. The bond market thinks that the first rate cut is likely to happen in May, but there's actually about a 33 to 34% chance that it actually could occur in March, which is really not that far away from now. If you think about what would make the Fed cut in March, it couldn't be anything good for risk assets. If risk assets are soaring, I wouldn't expect the Fed to start cutting. I would expect them to start cutting if markets are showing weakness, the unemployment rate's going higher, etc. While the unemployment rate has gone up a little bit over the last few months, that's what the Fed has wanted. They've wanted to see a softening of labor market conditions. They wanted to see the unemployment rate go up. They can say whatever they want, but one of the big issues with inflation is wage inflation. And the only way you're going to get wage inflation to slow down is to soften up the labor market. Make it so that it's harder for people to find jobs, so that you basically turn the market from an employee's market into an employer's market. And I think we're slowly starting to see that shift take place. But for a long time, they've basically, their job has been very easy to do in terms of you have to raise rates because you don't have price stability and you have maximum employment with unemployment rate at like basically 50-year lows when it was at 3.4%. But now their job does become a little bit harder. And the reason for that is because the unemployment rate is starting to trend higher, right? Like take a 3-month moving average, right? You can see that this thing is starting to curl back up here. The issue with this is that once it starts to go up, it can be very difficult to slow it down. And it takes often several major rate cuts to slow this thing down. So that, I think, is the important thing to watch here. And in the short term, one of the things that we mentioned earlier on NFA Live was continued claims are still going up, right? I mean, continued claims are now higher than they were at any point in 2022. So the labor market is softening up. Initial claims are not as high as they were, but again, initial claims have been low, and despite the fact that initial claims have been low, continued claims have been going up. So while people were getting laid off about the same pace that they had been for the entire year, people were having a harder time finding a job. Now the issue, of course, is if initial claims continue to slowly go up, then that could be another sort of tailwind for continued claims to go up. And the reason why that's important is if you look at say, unemployment rate versus claims, you can see that continued claims tends to lead the unemployment rate, and that is continuing to go higher. So inflation is an issue. The Fed needs to get it durably back down to their target. If they don't, they risk something repeating like the 1970s or the 1940s, where you just get several waves of inflation, and I don't think they want that. The only question is can they stay committed to it long enough to really get inflation out so we don't have to worry about it as much in the next business cycle. So we'll continue to follow inflation and see how it's affecting the economy, how it might be affecting markets. If you guys like the content, make sure you subscribe, give the video a thumbs up. And again, we do have the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.